you doing, kids? Wanted to discuss some investment strategies with you guys, and we'll go through this. And eventually, at the end of it, we'll dovetail this into a quick spiel on stocks and the stock market, because where we're going to go next is the stock market game with the investment and stuff like that. It'll be fun. It's a contest, but I want you guys to be armed with some knowledge going in. Also, a little bit later in the week, or maybe early next week, I might have you guys look at some stuff um, like the Great Depression or the stock market crash of 2008, and talk about that a little bit. But it's better, and you'll be, smarter, to use kind of a loaded term. You'll be smarter, I think, after you look at stocks and the stock market a little bit, to understand that history and some of the big effects of things that have happened with the stock market. So here, before we get into all that, here's some just regular old investment strategies. Probably a bunch of you guys have a savings account, pretty standard. A lot of just regular kids will have a savings account. With just about all these things, there's pluses and minuses, good and bad things about it. So what's good about a savings account? Well, it's real simple. You just keep your money in the bank. You can accrue some interest. It's very liquid, what you would call liquid in money terms, meaning you can exchange it or move it or something like that fairly easily. However you want. You can move it over to your checking account, write checks from it, or you can use your ATM card and pull it out of your savings account, or just walk up to the bank. So those are some nicer things about a savings account. But the downside, you're not going to make money very quickly. It's very conservative. For right now, even interest rates are very low, historically low interest rates. So you're not really making probably more than 1 or even 2% on a savings account anywhere. So that's the downside. We also have these things right here, certificates of deposit, or CDs. They're typically called. CDs are sort of like savings accounts. They're like a savings account on steroids, so to speak. The good part of it is you're going to make more money with a CD. You have a higher interest rate and rate of return on it. So that's a good way to go sometimes. But the downside is that you can't really touch the money for a predetermined amount of time. Usually it's about a year or so. So if there's some money that you don't want to touch for a while, or you can afford to live without, it might not be bad to put that into a CD. Before I went to boot camp in the Marine Corps, and I was going to be gone for 3 months just with nothing, and then after that I would have gotten paid for those months. I put my money into CDs, because back in the 90s you could get like 6-7% on a CD. So that was good for me then, but now, like I said, the interest rates are really low, so that might not be the best thing for you. IRAs, individual retirement accounts. Basically, this is something you put money into. A lot of companies will run IRAs. Companies and financial institutions will run IRAs. You put your money into these funds, so to speak, and a professional investor will invest that money for you. So I have an IRA, and every once in a while I get back a little readout on what's being invested in, and it's got a little pie graph and a little chart. Did it do well or did it do bad, depending on how the overall economy was and the investments. But that's pretty typical. A lot of your folks, parents will have IRAs or something like that for their retirement set up, and professionals pretty much run those things. So it's better than you or me just sitting there pulling the trigger with E-Trade or something like that. They come in 2 different kinds, standard or Roth, all right? And the differentiation between those two has to do with taxes. Taxes is always sort of an ever-present reality in the money world. So with a standard IRA, you put your money in, and when you take the money out, you will pay taxes on all the growth in that money. So let's say with just cash coming out of your paycheck, let's say over the years you put in $60,000. You're not paying cash on $60,000, or you're not paying taxes on $60,000. You'd be paying taxes on $60,000 plus whatever else that money grew into as people invested that to you with your IRA. So you do not pay taxes when you put the money into the standard IRA, you do pay taxes on the principal plus whatever else accrued from investments when you take it out. And the expectation with an IRA is that you're going to take it out when you're an older person, like 65 or something like that. The other kind is the Roth IRA. I have a Roth IRA. With a Roth IRA, you pay taxes when you put the money in, as you're a working wage earner during your younger years. But when you take your money out as an older senior citizen, you are not paying taxes on any of the original money you put in, because you already did, right? Plus the growth. So that's the Roth IRA. And with the expectation with the IRAs is that you're going to leave the money in, okay? You got to leave your money in the IRA. Typically, if you take the money out of an IRA, you will be penalized. You'll take out whatever money you need for your emergency or something like that, but then you'll get penalized monetarily for that. Also, we got mutual funds. They're kind of similar, I suppose. It's an investment vehicle. It's run by professionals, and professional companies run that, like, for example, Vanguard or T. Rowe Price or Wells Fargo. Those kind of guys might run mutual funds, and there would be other companies, of course, too, but that's just some examples. But mutual funds run by professionals. A fund is just sort of a fancy word for a big bucket of money. You're putting money into this fund that, they're investing this money for you. A mutual fund can be sold, so you can get rid of that thing. And they come in two varieties also, the loaded and the no-load mutual funds. A loaded mutual fund is usually a little bit more pricey, and the people that are running the fund for you, they work on a commission, meaning if your fund does well, they get paid more. So if your fund does bad, they don't get paid much at all. But it goes back to that incentive that we always talk about here in economics, I suppose. There's also what you call no-load mutual funds. And in those kind of mutual funds, the people are salaried investors, salaried employees. So if you do well or you do bad, doesn't matter. They make the same amount of money. I'm sure they care. It's not, something where they just don't completely care, but that is the difference in those two funds. Down here, we've got the ETF, or an exchange traded fund, all right? An exchange traded fund tracks an index, all right? So usually these are going to track things like, say, the tech market, and they would have your ETF in the tech industry. The tech market would have money that's invested in stuff like Apple, Google, Microsoft, all those hotshot kind of techie sort of companies. And if they generally do well, then your fund makes money. If they get hammered somehow financially, your fund doesn't make money. So it could be in those sorts of indexes, or it could be in something like precious metals, gold, platinum, silver, stuff like that. You can get an ETF that tracks the Dow Jones Industrial Average for the stock market. So that's an ETF. Right here, we've got something called the 401k. Probably, if you ask your folks, I guarantee a bunch of them are going to have what's called a 401k, or a defined contribution plan. Defined contribution. So you have a certain amount of money that you have to put into the 401k. Again, it's a fund. People invest this professionally, so it's not you or me out there just messing around with E-Trade or something like that. There's a certain security and everything with having professionals invest it. They can be portable usually. So sometimes one of your folks might move from job A to job B, and it's usually a hassle for someone who's in this sort of situation, because they have to do some paperwork or something and get their 401k moved over to their new job. This is probably in your future, a 401k. This is more of the new school way to retire. Back in the day, a lot of companies would just have retirement. You work for Ford X amount of years, like say 25 years, you retire, you just get a retirement pension. American companies don't really do that anymore. It's more defined contribution plan. And sometimes they'll have like a certain sort of benchmark amount of money that you put in, and they'll match it. Like it might be, say, you put in $2,000, the company will match $2,000. So you'll have four at the end of the year. So it pays you to sort of keep up with the 401k and keep putting your money in. All right, so that's, again, probably in your future. I don't have a 401k, so probably if you ask your folks about it and they're real savvy, they might even have a lot more information than me, but it's not something I play with or have to really monitor myself personally. Below that, we've got the defined benefit plan. So this is in my future. If one of your folks is in police, fireman, maybe a civil service worker for the government, if they're retired military, they're probably going to have what's called defined benefit plan. Teachers, public school teachers definitely will have a defined benefit plan. So you'll pretty much see this with people who are employees for the federal government, the state, maybe city, municipal government, like the city of Philadelphia. And this is more of like your old school retirement. You will hit a certain year or length of service in this organization, like let's say Philadelphia Police. You will retire and they'll pay you X amount of your salary or X percentage of your salary for the rest of your life. So you could live 5 years and you get X amount of your salary every year. And you could live 40 years after you retire. I don't know. It's going to be different for everybody, but that's basically how that works. This can be nice because there's sort of that feeling there that they're never going to run out of money. Like let's say you did 20 years in the Marine Corps. You're a retired Marine. You did 20 years. I mean, if they're ever going to completely get rid of your retirement, probably something really bad happened to the entire country and there's going to be blood on the streets and everything. Like it'd be a big deal. It's pretty nice if you have that. 401k could be risky with like market fluctuations or something like that. But on the other hand, the government's not running that. So, I don't know. If I worked for Philadelphia for 20 years, what's Philadelphia's debt load? How are their finances looking? I don't know. It could be dicey. But usually this is pretty secure and mostly people are very happy with it. Bonds. You can get bonds. A lot of you guys might even have bonds. Just usually if I ask in a classroom, does anyone here have a bond? There's going to be a tiny handful of kids that'll put their hand up in the air and say, yeah, I have a bond. So what is a bond? Literally, a bond is just a piece of paper, like this piece of paper, regular old piece of paper, and it's an agreement, right? So what's everybody want? Cash, right? So governments want cash. You give a government cash, say $25, they give you this piece of paper here that says, so-and-so gave us, the government, $25. We will pay them back at such and such future date, $25 plus whatever interest accrues on the $25. So a lot of times governments will do that if they need cash. Sometimes you'll see in your history class, they might have war bond sales. There's usually a lot of really cool like artwork and posters and stuff for say World War I or World War II, where the government's trying to sell bonds and get cash in from people. Is it taxes? Do you have to do it? No, you don't. So that's kind of nice for the government. Nobody likes paying taxes when the government kind of gets your arm and does that and says, you gotta pay, or else you're gonna get in legal trouble, right? But a bond is voluntary. You don't have to do it. So that's why they would have all this advertising and posters up, and sometimes they'll have movie stars come around and try and sell bonds to people and stuff like that. But again, that's more of a historical kind of thing, like World War II, World War I, things like that. Corporations want cash too. Companies want cash. So you can get corporate bonds as well, right? You can get probably Apple bonds, or probably a bunch of other companies will sell bonds. But what's good and what's bad about them? Just like everything else, there's positives and negatives. Good, usually they're very secure. It's a very secure investment. They're very low risk. On the other hand, we live in a high risk, high reward world. So low risk, low reward. you're probably not going to make that much money. You know, when you gamble big, that's when you make a lot of money. Or, of course, you, as we'll see, you lose a lot of money. Now we come down to futures. All right. Futures are a little tough to understand sometimes. They're usually traded in what's called commodities. Commodities are things that you can touch. Copper, gold, corn, cocoa. Also, you'll see futures markets for different kinds of currency, US dollars, euros, whatever, right? Rubles, pesos. So you can buy and invest in different kinds of monies, international monies and things like that. So basically, a future is not really a stock necessarily, but it's meant to create stability for people that are in that market. And you'll see it a lot for agriculture. In fact, I think it mostly started in agriculture. But markets in agriculture can fluctuate wildly at times because things like weather conditions can change markets like that over a season, a growing season, or right now we've got the COVID flu virus around. I mean, what if there's some kind of virus that hits all the cattle? Like what happens to beef prices and stuff like that? So the futures market was created to address these kind of stability issues that they would have in markets for these commodities. So right here, we'll look at milk. Okay, our commodity is going to be milk. And we'll say the farmer likes to sell milk to the Nestle Quick people because they like to make what? Chocolate milk, right? You got to have milk if you're going to make chocolate milk. So they might have some sort of futures contract that agrees on a price of, say, $2 a gallon for milk. Now, a lot of different things can happen over the course of a year or however long that futures contract is. Maybe there's going to be some kind of crazy disease and a bunch of the cows die and it's going to greatly affect the price of milk. Well, they've got that $2 price locked in. So in the old stock market game that we used to do, you could trade in futures, and basically kids or even me, I would play the old stock market game version too, but you're either hitting a massive home run when you sell futures and buy futures, or you're going to completely strike out. It's more of a high risk, high reward kind of environment in the futures market. You could just completely lose your shirt. It's kind of complex, and if I was putting real money in, I'd be real careful if I started messing around with futures. Down here, we've got gold. That's right, gold, like little gold doubloons, pieces of 8 kind of things, like you see in pirate movies and all that. I actually bought gold a few years back, and if you follow me over here, I'll just kind of show you gold a little bit, but there are companies that will in essence sell you little gold doubloons, and I spent maybe about $2,400 or so, and I've got 3 of these gold doubloons, which if I'm looking here at gold prices now, this is just for gold in US dollars per ounce and just for today. So today is April 13th, 2020. So today it started at $1,683 and ended at, well, whenever the thing ends, but for right now at about 5:30 in the afternoon, it's about 17, I don't know, 12 or something like that. So it went up a little bit. So if you bought early this morning and you tracked it all day to when it got to $1,715, well, if you sold it, you'd have a little profit, wouldn't you? I guess so. Anyway, like I said, you can buy little gold doubloons from various companies, and this is just for the day. And I'll give you an example of sort of what I did, because I bought my gold coins back in about 2008, which is right sort of when the stock market got shellacked by, let me see if I can go back farther, got shellacked by the 2008 market meltdown. So I bought right in, somewhere in here, we're probably looking at about, say, close to $900 a coin when I buy. And, you know, it was just a kind of an investment I wanted to track and see if I could make money off of. But as that market went down, it turned out the price of gold went up. A lot more people were putting money in gold and investing in gold because they couldn't invest in stocks. So the price went up. It went up to, I'm just guesstimating here, but I remember watching it almost on a daily basis. This is probably about $1,800 or so. So I bought it at 900, and within about 2.5 years or so, it's worth 1,800. So that's about 100% rate of return. Now, boys and girls, learn from my mistake and don't do what I did, because I sold it. I probably sold it in about 2013, 2014, somewhere in here. And I got, instead of getting $900 per coin, I probably got somewhere around the order of about $300 per coin. So it ended up not being a huge profit necessarily from the 100% return on investment that I would have had, but it's not bad. It paid for a kid's hockey season pretty much is what I got out of that. Not bad at all, right? But I think from that, I learned that maybe you want to make rules when you invest, and you're a free person, you're free boy, free girl. We're in America. You make your own rules, and it's your money and everything when you decide to start doing this, or if you start doing it. But I guess my rule based on this would be, if you hit 100% rate of return, you should probably sell half. Again, I'm just making that up, and it's my rule, but what are you going to get back? Your whole original return on investment, and then whatever else happens to it is candy. If it goes up, great. If it goes down, too bad. It doesn't matter because you've made your cash back. So that's what I learned, and maybe you'll make up your own rule, but that's kind of how things went for me. Let's look at stock. I guess it's easier to show you stock than it is to explain stock, but a lot of times I like to go to Yahoo Finance. There's a bunch of other websites and stuff that'll do stock. There's actually a huge galaxy of information for stocks. So I don't know, I put on my email or something like that, my home email, not my school email, and I start seeing all this junky news stuff about Kim Kardashian or whatever, and you think that's like the only thing out there. You'd be surprised that there's so much more information, or at least as much information as all this other kind of stuff that people are buying and trading here on the stock market. So let's take a look at stocks and just kind of check one out. Hey, Caroline, what's a place that you like to go and, I don't know, eat or...
I like to go to McGurk's.
McGurk's is not traded on the market. What's like a normal chain restaurant or a cafe?
Giuseppe's?
No, not traded on the market. Not all companies are going to be traded on the market, and it's good you said that. Like, for instance, Wawa. Like, Wawa is the hugest thing around here. Wawa is not publicly traded on the market. What about Starbucks? You like to go to Starbucks?
Mm-hmm.
All right, Starbucks is publicly traded on the market. So usually you can just type in, there you go, I didn't even finish typing it in, the thing pops up. S-Bucks is Starbucks. So let's check out Starbucks stock prices right here. Okay, so here's our thing. Starbucks, it's got the name. Here's the price of a share. Looks like it's gone down a little bit recently. Okay, no big deal. So let me talk about some of what this is here and all this information and what it's related to. So if you're buying a piece of the Starbucks company, it's going to cost you about 70-ish, between $70 $75. But today, this morning, it opened at $73.52 a share. So the day previous, when the markets closed like about 4:30 in the afternoon. It probably closed at $73.88. All right, and then it opened down here. Bid and ask. I don't really use this stuff much for. I don't really use this stuff much for the buying and selling if I'm playing the stock market game. but bid is the highest price that buyers are willing to pay for the stock, and ask is the minimum that the seller is willing to accept. So to me, that seems kind of obscure. I don't use it for stock market game, but just so you guys aren't asking questions about it or anything. Days range, so that's where it opens, and that's the lowest to highest it's been today. All right, so it closed up near the high. $73.52 was the high, and I'm sorry, was where it closed, and $73.57 was the high. This was where it was lowest. And of course, you could track that along this little item right here. So here's 9:30 when the markets are going to open, 12 noon, and then you get to about like 4:30 when the markets close. So right there. All right, the 52-week range. So this is the yearly, the lowest it was this year to the highest it was this year. I'm assuming this was probably a little while before all the shutdown type stuff happened with COVID-19 flu, quarantine stuff. So that can't be good for business for Starbucks for sure. Volume means how many shares of this thing have been traded. And I think that's a yearly calculation, and the average volume is 13,000. So market cap is just a short way of saying market capitalization. That means basically how much cash they're sitting on in the bank. 84.225 billion they just have sitting in the bank. That's their market cap, their market capitalization. Beta, I don't really use that. I don't know much about that. PE ratio. All right. This stands for price to earnings ratio. And essentially, this is like a golf score. You want this to be low. This is a relatively low price to earnings ratio. It's not super high. But as you guys go through and explore, and I encourage you to explore and look at different stocks, even ones that maybe you aren't interested in buying, just to get a benchmark and sort of a feel for it, just go through and look at different ones. But PE ratio is price to earnings ratio, and you want it to be low, like a golf score. EPS, I don't use that. Earnings date, I don't know what that is. Forward dividend and yield. Dividends are money that a company pays you just for having its shares of stock. So sometimes it's a common phrase you might hear people say, oh, that paid dividends. And they might not be referring to stock or anything investment related at all, but the word dividends is just sort of out there. If I look at this button that says historical data right here, you can look back and look at all the old prices. So when did we get pushed out of school for quarantine? Probably like, I don't even remember. What was our last day? Somewhere in mid-March. What, March 13th maybe? No. Probably somewhere down here. So looks like our prices were a little bit higher for this stock back in like February, before all that flu stuff really was in our face. And look, here's their dividend. So if you have shares in Starbucks, they pay you dividends just for having their shares. So the dividend here, let's say you have 100 shares, right? You just move the decimal point 2 places over. Boom, boom. You get $41 if you have 100 shares of 100 shares of Starbucks, right? Some companies will have dividends, some won't. So might be good for you guys to go through and explore and see who offers dividends and who doesn't, right? Let me back this up a little bit and see if there's anything else here. So you can really look at all different types of companies. And like I said, there's different websites that do this. What kind of car would you like to have, Caroline, when you grow up?
I don't know.
Anything.
I don't know.
All right. Well, let's just look at Ford. Ford Motors. There's Ford Motor Company. It's just symbol F. All these things are going to have a symbol, and you don't need to have that memorized, but you'll get to know them as you go through and explore stocks. But here's Ford Motor Company. Okay, so $5.16 for stock, and there's their market cap and a bunch of the other stuff that we looked at. They seem to be down too. This, in the red here is like not good, pretty much. But basically, I would say, and I'm gonna explore a little bit here. I don't know per se, but maybe it's not a bad time to buy. Look at how some historical prices. They say it's good to buy when there's blood on the street, right? It's just a phrase. I didn't make it up. But look at this. I mean, it was down to $4.71 the other week, $4.71. But before that, it was up here like 8, 9. And I'm going to go back to 2008. If this thing lets me, 2008, 2009. I wonder if it lets me go that far back. I don't know. It's only going back a year. All right. But I mean, this was really worth just a few cents back then in the wake of that stock market crash in '08. So in a way, everybody says, oh, the market's bad, the market's bad. But if you're new, if you're like a kid like you that's coming into it, or we're just playing the stock market game, maybe now's the time to buy. When everything's wrecked and it's cheap, that's the time when you want to jump in. A few months ago or 6 months ago, when the market was at some of its highest prices ever, I mean, I don't know if you want to jump in. There was a really great hockey player, years ago. I was a kid. His name was Wayne Gretzky, the great one. And he always said, don't go where the puck is, go where the puck's going to go. And that's what you, as a kid, I know it's a hockey analogy, but as an investor, you don't want to follow it. You don't want to follow the market and chase it, because you're just losing. Like, it's already gone by the time you get there. You want to try and think about, where's the market going to go? Look at things like they could be future trends, or things that are coming down the pike, or things in the political world and financial world, like who gets elected president, what's happening in different countries. I got to do a teacher workshop, and I was on the floor of the stock market, and they've got all these TVs and stuff set up, and the guys who are traders are down there. There's not as many as there were in the old days. A lot of the stuff's automated now, but they've got TVs everywhere. They're very information wired sort of industry. So they always want to know the news. They always want to know current events. Maybe you do something for Dole Fruits or something like that. What if there's an earthquake down in Guatemala or Ecuador, one of those places where they grow bananas and stuff like that? What's that going to do to your business? Like, you want to be on top of that and know that. Or like coffee beans. A lot of that stuff comes from Central and South America too. What if something happens with the coffee bean crop, or there's some kind of calamity with that government or that country? You want to know that. So it's a very information dependent sort of thing. So it's a good time. It's a good time of year. I wish we were in school, and it's more fun to see you guys compete with each other in school for the stock market game. But I'll get some instructions out for you real soon, and I'll let you guys get kind of snapped in on that and get some time with that. And it should be real fun and competitive. And of course, like I said, if you win, you don't take the final. And I guess I'll just make a final too. Open book, open note, but still, it's a final. It's not fun. Anyway, guys, I think that'll be it for today. You can always ping me with questions about stock market stuff. I might be able to answer them. I don't know everything. I learn new stuff every year, literally every year with this stuff, investing and all that. There's always more to learn. You can ask your folks. Some of them might know a lot too. But I think that's it for me today. I'm going to sign off. Thanks. Bye-bye, and have a good one.